Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market Site, we have Joyce and Maddie Radner, Managing Directors on Nasdaq's Market Intelligence Desk, as well as Marta Norton. She is the Chief Investment Strategist of Empower. We're here to discuss favoring breadth over conviction and why a diffused approach across sector, geography, and style makes the most sense in this market. It is great to have all of you with us. Marta, welcome to the show.
Thank you.
And before we get into your trading approach, your investment approach here, overall thoughts on the state of the U.S. economy, because we've round-tripped.
We round-tripped. It does. It feels like Liberation Day was just a bump on the road, and we're back to normal. I think it's hard to have a unique thought on this, because I think it's been well covered that what we're dealing with is uncertainty, and it's well understood that trade policy is, yet to be fully defined as we go forward, and what that disruption looks like for earnings, for inflation, for the labor market is all yet to be understood. But I think one thing that jumps out at you as you're looking at earnings, or whether you're looking at the CPI prints as they come out, or the unemployment numbers, is that we're starting from a very healthy place. So at least if the direction is negative, it's negative from a high start value.
Yeah, so it makes you wonder if these policy shifts, if you rip the Band-Aid off right away in the beginning versus trying to guess, okay, in a year or two, are we going to start to have tariff talks and so forth? We saw what happened with the 1.0 administration, where it was 2 years in, and the volatility in December 2018 at that point. So at least the Band-Aid's ripped off, and we know what we're looking at to some extent.
I think we do know. I think there's still some open questions, though, for specific industries like semiconductors. What do tariffs look like there? I think there's questions on what's the floor and what's the ceiling. We know it's not 145%. We also know it's not zero, so somewhere between 10 and 20%. We're kind of closing in on a range, but there's still uncertainty around what that looks like, and then how companies respond, whether they pass prices along, whether they take the hit themselves. I think all of that's still unknown.
Brian, let's take a look at the S&P 500 for a moment here and get some fresh levels. I mean, the move has been quite remarkable. Not even just the intraday swings that we've seen, but the round trip back to Liberation Day.
Yeah, so we've blown past that. We've gotten back above the 5,800 level, which I know a lot of technicians were watching as an expected resistance level, and that was the upper end of that resistance range. And so now we're within a few percentage points of all-time highs. And so what's noteworthy is that the breadth of this move has been quite strong. So we're looking here in the lower panel. So the upper panel is the S&P 500 with the, like I said, within a few percentage points. The lower panel is the advanced decline line. That broke out to new all-time highs. It's showing the breadth within the S&P 500, advances versus decliners. And that broke out to new highs in basically the first week of May. And so we had some breadth thrusts that actually happened the week prior, which looks more at a broader range of equities, where we had an extreme pessimism given what was going on in early April. And by the end of April, we had a reversal where more than 60% of, say, the NYSE advanced decline line was now in a strong uptrend. And that's very rare. It's the 20th time it's happened, going back to the 1940s. The prior 19 times, the S&P 500 has been up 6 months out and 12 months out, 100% of the time. On a 12-month basis, the average return is over 22%.
Wow. That would be an exceptional follow-on concerning the past 2 years of performance that we've had. So I guess the question is, from a technical perspective, it's going to have to hold that level, or can it hold? Should we break?
Well, certainly. The technicals, I think, are just representing, what's going on, all things included, not just the fundamentals, but the sentiment. And we've certainly seen a very strong rebound. I think maybe the expectations and the uncertainty, as you noted, around everything has had a lot of concern about CapEx, future hiring, and I think maybe we've just kind of that hit extreme levels. So I think the sentiment is still bearish. I think you look at the BofA Fund Manager survey that was very bearish in mid-May. So I think there's plenty of reasons to think why maybe the sentiment hasn't yet gotten, the pendulum hasn't yet swung too far back the other way on the extreme bullishness side. I think we have a ways to go.
Well, I mean, look at the exuberance we had following the election results into, let's call it Liberation Day for the most part. I mean, there was a lot of ground that was made even before we understood what this situation was going to look like. I mean, you have to start asking yourself now about market valuations. Did that window close?
Yeah, I mean, that's what's top of mind for me. So you did see this massive response to election and kind of this enthusiasm. I believe the S&P 500 had its best single-day performance post-election, with the Trump election. So a massive response. But then, of course, you have, as you roll into 2025, you have especially Mag 7 get hit really hard, with the DeepSeek news in January, February timeframe. But the rest of the market holds up pretty well. Consumer staples, for example, this kind of defensive, forgotten sector does quite well. And now you have this leveling off where the rest of the market looks pretty pricey, but Mag 7 still looks cheap because they got hit with that 1-2 punch, both with DeepSeek, then with tariffs. And so it's so strange because at the start of the year, it was, gosh, it's Mag 7 concern from a valuation standpoint. And now Mag 7 seems a little bit more approachable, but the broader market on the whole, some of these sectors, consumer staples in particular, at least in our estimation, are trading in the most expensive decile relative to their own histories.
Yeah, and Maddie, small caps, they've been cheap for a long time.
Yeah, so post-Liberation Day, a couple months ago, we were commenting that large caps were the clear winner this year, which could still be the case, but we could really see a potential for small caps to recover a bit more this year, especially as tariff negotiations continue to play out. There's a few reasons why. So we're seeing attractive valuations in the small cap space. They're trading at a pretty significant discount. We're seeing earnings growth really accelerate in the small and mid cap range, and small and mid cap growth could really outpace large cap growth in the coming quarters and maybe into next year. And then small caps are also domestically oriented, especially compared to some of the multinationals in the S&P 500. So that, coupled with tax cuts and deregulation, could provide some tailwinds for the small cap space.
Yeah. Brian, what does the Russell say in terms of technicals?
So we're right up against it's called a pivot, a 2110 level, which is where on the downtrend in March, we rallied and installed at 2110, and then we went lower. So I'd call that very minor resistance. A couple of percentage points above there, 2175 is the 200-day moving average. If you look at a longer term chart, relative small caps relative to large caps still clearly have a strong upper hand. So I think on a quarter-to-quarter basis, anything's possible. So on an absolute basis, 2110 right now, and Russell 2000 is the key level.
Which is so interesting because we're also hearing from the other side, from the bond market, that perhaps the equity market isn't taking cues from what we're seeing in the bonds and with rates, which is interesting as well.
The equities, as far as what exactly?
You would think that equities wouldn't be performing at the level that they are, considering some of the disconnect that has relative to the fixed income space.
Yeah, the long end of the curve is trading higher. The 30-year is close to 515, 520, which is where it peaked in late 23. The 10-year, it's not close to its 23 highs, but 475 was the double top high in 2024. So the market is still pricing 2 rate cuts at the moment right now. We were pricing 4 at the beginning of May and a month earlier. I think what's the reason for the long end going higher? Is it fiscal concern? Is it growth? I think that's important as to the reason as to why the curve is steepening the way it is. I think banks in their, through their earnings season, they've had pretty good numbers. I think this quarter we're seeing on the capital market side, banks are speaking optimistically about trading. So, and then on the regional bank side, with the branch bank lenders, I don't think that there's really been much credit risk concern at the moment. So, employment's still holding in.
Yeah. Well, I mean, it's interesting, Marta, because it's a relatively quiet week for data. However, everything that comes out of Washington, every tweet, every headline, every press conference, stimulus and the looming deficit, that's what's going to be, moving the market at this point from a macro perspective.
Yeah.
I mean, this policy that they're trying to get through, and then what we're going to do with the deficit.
It's big questions. It's actually funny because it feels as though 2025 is the year of fiscal policy. If there's one thing that moves the market, it's fiscal policy. We have tariff news, and I think the tariff news is not dead. I think that's still going to be a swing factor as we look at how the markets behave over the summer. But then we also have this tax policy, and the interesting thing about the tax policy, there are still so many ifs here, so it's hard to be overly definitive. But the interesting thing about it is that it's extension broadly, not expansion. So when we think about, yes, there are some additions, overtime, Social Security tax, removing taxes on that. But when you think about the corporate rate tax, back in Trump 1.0, we saw that effective tax rate move somewhere from 35% down to 21%. We're holding that steady at this point. There are some sweeteners in there when it comes to depreciating expenses and that kind of thing, but you have to wonder, is this going to be the stimulant that people think it will be, or is this just going to kind of manage the status quo? Now, I think any good news is going to be met with enthusiasm for the short run because we want to have good news. But I'm not necessarily sure it's kind of a long-term stimulant the way we saw in the first go-around with Trump.
And that's what the challenge is that there's a lot of can kicking that's taking place. I mean, we saw the reaction the market had with the 90-day, moving that out with Chinese tariffs. But that conversation's still going to come up at the end of the summer at this point.
That's right.
But guess what? Midterms are happening.
That's right.
That's what they're going to be focused on.
That's right. And I think there is this desire to have some wins going into kind of midterm and campaign season and that kind of thing.
Yeah. When we look at the pipeline, Maddie, for IPOs, it still feels strong, and it's across multiple sectors as well.
Yeah, the pipeline remains really healthy. So far this year, we've seen 130 total IPOs across the U.S. exchanges. It's the SPAC IPOs that are really coming into the picture again. SPAC IPOs have actually captured over 40% of the capital raised so far this year. In May, we've had 13 SPAC IPOs, which is the best month since February of 2022. Back in 2021, we had months where we had 90 or 100 IPOs each month. So we're not going to be getting to those levels anytime soon. But as traditional IPOs continue to face headwinds, at least for a little while longer, the SPAC route is very attractive to investors. It's an alternative way for investors to raise capital and for companies to ultimately go public.
Yeah. Brian, what are you hearing from the issuers that you cover, Nasdaq listed companies, and how they're thinking about the macro environment and modeling out their risk and budgets?
Well, I think what we're hearing, like Jamie Dimon from JP Morgan was noting that he's been seeing companies talking about lower CapEx, but I don't think it's been that dreadful, lockdown or, similar to kind of COVID where we just locked down the economy. But I don't think everyone is just completely, pulling back the reins on that. So I think that's what we've been seeing in the marketplace. This recovery in equities is maybe, things aren't as negative or uncertain as initially feared, let's say in early April. So I think it's relatively better, but it's a fluid situation, and so we'll see how the rest of the summer and the fall unfolds. And go from there.
Yeah, you've been consistent about that, and it certainly has played out if market action over the past 6 weeks is any guide. So when you're thinking about a little bit more long term here, you're putting this all together. It sounds like it's a market that's going to continue to grind it out.
Yeah, that's the way it strikes me today when we look at kind of taking the mosaic approach and we look at the health of the economy. And I think that's what you're pointing to when you think about companies not pulling back as much on CapEx. They're in a healthy position, but there's still that uncertainty when we think about how this all comes together from a tariff perspective, from a tax policy perspective. We have the deregulation front, which is of course stimulus, but it's harder to quantify. We can't see that as clearly as we can see tariffs and taxes, but of course that's another factor at play. But then you marry all of that, the uncertainty for a strong economy with valuations, and it's hard to say there's an upside surprise here that's really going to push these valuations much higher. I would say when you look at something like small caps, there's some optionality there. If you do think the economy could surprise to the upside, that would be a place to be because valuation matters, but so does economic sensitivity in that part of the market. And then you compare that with something like Mag 7 that has a whole lot more financial resilience in a more difficult market environment. So I think there are some opportunities there, but it's hard to imagine that there's just kind of you can throw a dart and find a great name. It feels like the stakes are a bit higher.
Right, and to Brian's point too, not seeing CapEx slow down, I think that is, in any market environment, something that's what's going to provide for future growth.
That's right.
And to earn those multiples.
That's right.
So even if in what's been considered a more challenging operating environment, if you can execute on that model now and then also set yourself up for long-term future growth, it could be, some interesting opportunities.
The one thing I do worry about though is that I think we hear the April 2nd announcement, we see all the activity since, and then we look at the economic data, the earnings data, and we say, oh, nothing to see here, everything's fine. And I do think that there's a kind of a longer tail here that we just have to be aware of. We can't let complacency set in. We do have to recognize that there has been a sea change in trade policy.
And I do think companies are recognizing that. I think 80% of companies in the S&P 500 did cite the word uncertainty this
Sure.
year on their earnings call. So they're still waiting this out to see how it's going to play out in the next
And
couple
you've also seen a number of guidance scenarios where they have like an if and
Yeah.
Yes,
This-
scenario analysis.
this could happen, which I think, Brian, at the end of the day, I think it's the prudent thing to do for investors, because this is the type of scenario, this is what we foresee, and vice versa if it plays out another way. I mean, at least you're providing something and having an opinion on it, and not just pulling it all together.
Yeah, and another concern I would add is housing. There's a lot of uncertainty there as well, and uncertainty is such the buzzword, but it is what it is. There's a lot of uncertainty, I think, with the housing market, with rates as elevated as they are. We haven't seen existing home sales really, lift off. They've been hovering around those lows for the last 2 years now that we haven't seen since around 2010 or so. So, and then home builders, new homes available for sale, those inventories are growing as well. They're definitely above the pre-COVID levels, or back to those levels and a little bit elevated now. So, will that impact construction employment? Going forward, will the tariffs impact commodity costs or the inputs for home building? So all of that is something that, as you said, is a lag effect there. We're not going to see that in Q1 earnings. So we'll see how that unfolds.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.